The actual funding market that founders in this region are trying to raise in right now. That's what it is. Lowest quarterly deal count in 8 years. Let that land. This has that tie-in to being able to run frontier AI at scale. Hence, a lot of the hype that's coming around this company. And yes, this is genuinely significant. So these are not problems that these firms are necessarily ready yet to parachute in and solve. They require some of the local knowledge, local language, local relationships, and the kind of long-term on-the-ground presence that a foreign firm cannot necessarily realistically provide as of yet. And we're back with Sea of Startups. Let me tell you what has actually happened this week. Not the press release versions, the actual version and what it means. So we're going to take 3 stories. All of them matter, and we're going to put them next to each other, paint a picture of what the region is going through now. The first story we're going to talk about is the Q1 2026 funding report that recently dropped. We're going to strip it apart and try and get an understanding of what the numbers are actually telling us. Story number 2, Skychip is going to list on the Bursa Malaysia, and the retail portion is quite oversubscribed. So this is holding itself up as a big moment. And story number 3, global by nature, but certainly is going to have impact here in the region, which is OpenAI and Anthropic have both launched enterprise AI services companies, not products, services companies with billions behind them. I'm Kevin. This is Sea of Startups, real, raw, relatable. So let's get into it. Story number 1, as I said, Deal Street Asia dropped their Q1 2026 Southeast Asia funding report this week. It is certainly making the rounds. And the headline number is that Q1 total capital raised during the quarter amounted to $2.8 billion. And that is the highest quarterly total since Q4 2022. And we have to ask, is this a recovery signal? Well, here's the problem. One deal, one single transaction has accounted for the preponderance of that number. And it is a data center operator, not really a startup technically, and it was spun off of another entity, but it's inside of their numbers, and it's inside of that 2.8 billion. So we're going to talk about it because they do call it a Series C. So I guess, we've got land of fuzzy definitions. And they alone raise $2 billion. So strip that out, and what do you have? Well, you have at 90, just shy of 100 deals that raised a total of 800 million if you cut out that one deal. And in that mix, you also have Amity, which raised 100 million. And there's a couple of other big rounds in there as well. So when you start stripping out these bigger deals, it's painting a lot gloomier of a picture. So it's still quite thin. We're not in recovery picture. And it's actually, for the region, the lowest quarterly deal count in at least 8 years. The actual funding market that founders in this region are trying to raise in right now, that's what it is. Lowest quarterly deal count in 8 years. Let that land. Now, one of the other things that ends up always getting highlighted is Singapore capturing the vast majority of it. I'm honestly always a little bit skeptical of those reported figures because, as we all know, Singapore is the home of the holdco. If you're raising and you're trying to raise international capital, you're not going to stay registered in your home jurisdiction. You're going to raise by putting a holding company in Singapore, legal, regulatory, etc. environment sits there. operating company may be in your home jurisdiction. So it's always unclear in these reports whether or not we're just seeing that or whether or not we're seeing something else. But what it does definitely mean is it emphasizes the importance of that Singapore jurisdiction. Now, an area that they say is a bright spot is Malaysia, saying that it ranked second by deal volume. There were some interesting deals that happened in this period, but the key thing that amounted to this higher figure was essentially small checks from a small accelerator that ended up boosting the numbers. So the question is it really a indicator of a vibrant ecosystem, or is it just kind of noise that should be taken with a grain of salt? As somebody that's active in the ecosystem in Malaysia, I would go grain of salt myself, but I don't want to be the skeptic that's just touting the bad news or trying to be the damper. But certainly room for improvement across the region. We'll see how that ends up playing out. So, if you're a founder and you're asking where the money is actually going, well, unsurprisingly, as it's the global trend, surprise, surprise, what is it? It's AI. And specifically, we're seeing a lot more going into agentic automation of workflows, areas that execute tasks with limited human intervention. AI, ML deals climbing, the second place by volume in Q1. As I referenced before, top deal in that space was Amity raising 100 million. That's another one that we also have to look at. It's, the descendant of CP, lead investor, long established relationship with CP. There's definitely some relation there, but nonetheless, still an interesting company, still a great funding round. So kudos to them, and it's also an indicator of some of the appetite that's going on in this space. So if you're building an AI, maybe that's the place where you need to end up being. But you need to look at real enterprise automation. You need to look at real productivity gains. You need to look at real measurable output. And there is capital out there, not a lot, but it does exist. And I'm sure that as we see the subsequent reports coming out in future quarters, we're going to see AI being the mainstay theme continuing. Now, let's take a slightly different angle and talk about something that doesn't get a lot of verbiage in the ecosystem. The quiet part out loud, as they say, but it needs to be said. And there is a growing number of zombies across the region. We've talked about it in the past, and we still hear stories about it. There's plenty of companies out there that exist, technically alive, but operationally stuck. Nobody wants to take a down round. Many of the funds are still new. They don't want to take the bad medicine of seeing a markdown, so they're just staying flat, keeping that paper gain that was on their books so that they can go around town and start talking about what their TVPI is and what their multiple is, what their book value, holding it as, even if the numbers on paper don't actually make as much sense anymore. So this is creating a downstream problem because in some instances that we hear about, deals may be getting blocked by investors that don't want to see down rounds. Not a major topic, definitely happening. No pointing fingers here. It's a tough thing to end up dealing with, but oftentimes, sometimes you got to take one step forward in order to take two steps. One step backwards. Sorry, one step backwards in order to take two steps forward. So there you have it. We have mixed review, still quite thin on the deal landscape, but there is a silver lining for anybody that is focusing on AI. There's an interesting relation in regards to data center deal, because that's a lot of money raised into data center. We've talked about in past episodes the data center boom. Let me tell you about our friends at Your CFO, the financial planning system for your B2B startups growth. Running a business is hard enough. You're focused on product, you're focused on sales. You don't have time to hire your own CFO or maybe even your own bookkeepers, and your CFO is here to help. Building your forecast is easy as 1, 2, 3. You set your business as usual case, then you set up what your growth initiatives are going to be, whether it's launching new products, hiring plans, market expansion, and put those all together and generate your final forecast. And with your projection set, you can run variance analysis, stay ahead of any shortcoming or overachievement so that you can adjust in real time. Need to look forward? You can build out your rolling forecast. As the actuals update, you have new and improved forecasts. Have fundraising plans in the future? Build out your forecasted cap table. Understand what metrics you need to hit those valuation targets. And last but not least, all those board reports, investor reports, fundraising, financial projections, all exportable, all buildable, all in one place. So go to yourcfo.tech. That's yourcfo.tech to get started today and make an impact on your business. Let's shift gears a little bit and talk about a positive story and maybe unpack it to uncover some of the things that we dug into, which is Skychip, the Malaysia's the Penang-based chip design company, is having their IPO on Bursa, Malaysia's main market. That's happening. I believe that's going to be coming out next week. Lots of stories circulating around saying that demand is oversubscribed. Institutional is being anchored by government funds. Not surprising in that regard. They're saying that is oversubscribed as well by, I think the last number that I saw was 35 or 40x. And the public tranche, which is reserved for the retail investors, last number out that I saw was 95 times oversubscribed. Lots of retail demand. They're saying that this is the biggest retail subscription in Malaysia since Petronas Chemical back 16 years ago. That's how big it is. It's coming out, and it is the boom. I mean, everybody who's watched NVIDIA's share price skyrocket. We've seen the resurgence of a lot of the players there. We've seen up and down the stack, understanding the relation between the boom in AI, the boom in compute, the boom in data centers. All of this circles back to chip and the players that are in that stack. So for anybody that's listening that doesn't know what Skychip does, I'm not an expert on semiconductor industry within this segment, so I'm gonna do my level best in order to put it out there. So quick background, Malaysia's semiconductor sector has historically been stuck in the relatively low value back-end work, assembling, testing, packaging. That's where most of the jobs are. It is important work, but it's mostly the low margin end of the value chain. The government has pushed forward many different efforts in order to try and drive that industry to climb the value chain. So Skychip works at the front end. It designs the integrated circuits. More specifically, it owns and licenses silicon intellectual property, which is, the reusable building blocks that chip makers integrate into their own designs. So it's IP business sits on the front end. So think of it like this, if TSMC makes the chips, NVIDIA design what goes on them, a Skychip, not saying that they're servicing either of those companies, but Skychip is basically selling blueprints for specific components that go inside chips, such as what is coming out. Their flagship IP, at least according to my research, was HBM3E, high bandwidth memory interface technology. This is the memory architecture that sits inside AI accelerators running the large language models that power your foundational models. And this has that tie-in to being able to run frontier AI at scale. Hence, a lot of the hype that's coming around this company. And yes, this is genuinely significant. So kudos to seeing a story coming out of Malaysia and being able to see this. So let's take apart some of the narrative just to add some context for folks that aren't paying attention or haven't seen all of this. And again, caveat, not expert on this space. So coming off of my research, because I was quite interested to see this. So Malaysia, obviously, most people know there is a national semiconductor strategy. They have a long roadmap, and essentially it has as well the NIMP 2030. Essentially, these policy frameworks are, as I said before, targeting a move up the value chain away from the back end OSAT and into the front end IC design. That was part of many different initiatives. IC design parks in Selangor, Penang has a long industry. There's a bunch of that has gone into it. And Skychip is going to become, especially with this IPO and probably on part of the pathway to it, is becoming the poster child for that ambition. We can anticipate that there's going to be lots of publicity around this and showcasing, because this is essentially trying to show that it can build a giant company here. No need for a Malaysian to go off and build Broadcom somewhere else, can do it right here without leaving. Now, the ambition is good. The way to get there is still going to be very, very long. And what's genuinely real is Skychip is getting access to ARM Holdings design tokens under that Malaysia Silicon Vision Initiative. That's a national licensing arrangement that gives Malaysian companies access to ARM's IP. That was done, 2025 or something like that. There seems to be some case going on with it. I'm not going to touch any of the politics, but it seems to be, that deal seems to be in the news elsewhere. But anyways, that is a real strategic asset. So let's look at the financials. I dug in and was looking at their prospectus, and there is definitely some interesting news. Revenue up more than double over the past 2 years. Profit margins around 30%. Analysts, at least through some of my research, was looking at 31% earnings CAGR over the next 3 years. Bullish target price is essentially almost double what the IPO price is. Business model, as I said, IP licensing. You create the design once, you license it multiple times. High margins, scalable model. That's been done before. Think ARM, Cadence, Synopsys. There's a number of examples out there. Not reinventing the wheel, just executing on same business model, new IP. Those are multi-billion-dollar businesses that have been built exactly this way. Vision right, model right. Question is obviously always comes down to execution, risk profile, and whether the valuation actually reflects the reality of what's going on. So a number of risks are highlighted, and some of which required disclosures, I'm sure. Some of them are a little bit more meaningful. Some of them play into themes that we've talked about in the past, which are the geopolitics. Obviously, chips, we know what happened with the restrictions that were put on NVIDIA. We know what's going on with a number of these other areas. And here we go. So first, China. In the 7 months ending in October 2025, according to this, it said that China accounted for roughly 73% of revenue. Almost 3/4 in the most recent period came from Chinese fabless IC companies. They're selling advanced IP used in high performance computing and AI chips. And is there a risk that U.S. is going to end up extending their export controls? Prospectus explicitly acknowledges that if any of their customers get added to the US entity list. They would have to suspend supply. So risk sits there, something that everyone is probably already aware of, understanding of, risk factor nonetheless. Currently, none of their customers are on that list, but it's a current snapshot, not a forward guarantee. The company is also planning on apparently opening a US office. So there's still going to be this balance, playing the regulation, playing that sort of dynamic. So something to keep in mind as we look at that company. Second, tax exemption. This one is important because currently they're basically getting a very, very favorable tax rate, part of this pioneer status tax exemption that gave them essentially an effective tax rate around 2.7%. Obviously, well below what the real rate is. That expired. Now, from my understanding and from what I was reading, they've applied for an extension. But if it does not get extended, that means that that tax rate is going to jump by about 25 percentage points up to where the normal rate is. So currently the IPO is basically priced at 44x the fiscal 25 earnings. If you normalize that, just a little bit of back of the envelope math, if you normalize that, assuming the normal tax rate, you would be looking at more closely to a 57x effective or implied, let's call it implied multiple of normalized earnings. So that tax rate basically no longer exists. It was introduced. Can it be relied on? I'm sure most analysts have already been taking that into account, but it's something that's definitely worth noting. Other aspect, not uncommon in this industry, but there is customer concentration. So churn risk will inevitably be a challenge. There is a inherent aspect of customer concentration within this industry. I think the numbers that I saw were something about 3/5 within the top 3 customers. That's a pretty high portion. There was another number that I saw somewhere in one of the blogs that was analyzing it that gave a higher number. When you start digging into it, a lot of people have already been digging into it. It's relatively common. So the question here is are these happening on one-off sales or are they happening on recurring revenue models? It looks like a lot of the sales have been happening on a non-recurring revenue basis, one-off, high upfront costs. So there is a couple of question marks in regards to revenue quality, durability, etc. Now, mind you, is it still a good deal? Not my segment to be an expert on. Certainly, topic-wise, in regards to the segment that they're going after, it is definitely hot. That's why you're seeing this oversubscription. That's why you're also seeing institutional oversubscribed. It's also why you're starting to see all of this interest. It's not inherently bad to see a high institutional portion of these allocations. That's very, very, very normal. And so I think where I personally land on this is that it's a good success case. We need success cases of companies being able to find pathways to, especially in industries that are so topical, so critical, and to demonstrate that it can be done so that the next entrepreneur looks at it and says, okay, well, maybe I can too. The tech is real, front-end design, the ARM access, not fabricated credentials. The risks are real, but, this company has a genuine technological edge. It has a compelling narrative. And, all honesty, at least if you do some of the comparables, the valuation pricing is fairly optimistic relative to it if you start getting down into it, but it still that leaves enough room for upside if you paint it from the brush of understanding what the overall macro trends in the pace is in this is. Still a lot needs to be done on execution, but something to watch. So fantastic. Love these stories. Congratulations to them and all their investors. Last one that I want to wrap this up with. This is more of a macro global overall global story, but nonetheless, there are very specific angles that I think need to be taken into account for anybody that's starting in Southeast Asia. And that is because in essentially this same week, within a few days of each other, if I'm not mistaken, OpenAI and Anthropic, I think Anthropic first, then OpenAI second, they both announced that they are building enterprise AI services companies through partnerships with some meaningful names included into each of those partnerships. Not products, not model upgrades, not API pricing changes. No, they're building service companies where engineers go inside client organizations and build AI systems for them. That's a big deal. That's a big deal. Let's dig into why. Uh, OpenAI announced that the date I have is May 11th. They're calling it the OpenAI Deployment Company, launched with essentially $4 billion in initial investment from 19 founding partners, including with TPG leading the pack, Bain, Brookfield, Goldman, McKinsey, I think, was in there. And essentially the way that the model is that OpenAI embeds what they're calling, and the term that we're now all hearing all the time, forward deployed engineers, FDEs, directly inside client organizations. These engineers work with business leaders and frontline teams to figure out where AI can have the biggest impact, redesign workflows around it, and build production systems that can connect to companies' actual data and infrastructure. This is the new era of AI consulting firm. In addition, OpenAI actually also acquired a company called Tomorrow. Maybe I'm mispronouncing that. It's spelled different than tomorrow as in not today, but tomorrow, but maybe it's pronounced the same. And they're bringing in, essentially their staff of, 150 plus something like that engineers into the venture from day one. OpenAI retains majority ownership and control. And 1 week earlier, Anthropic basically announced the same with some of the same names. Goldman's in back, and basically it's the same concept. Backed by Blackstone, Hellman and Friedman, Goldman Sachs, General Atlantic, Apollo, GIC, and Sequoia. Big names. When you start comparing the names across each of these efforts, you're basically getting enough of like the private capital market and your capital allocators that is touching large segments of the overall economy. So there is a lot to be interested in regards to how does this actually play out over time? What is the impact going to be? Applied AI engineers embedded into client organizations, building specific solutions for them. Now, the framing of the Anthropic, at least from what I read, was targeting mid-market, which is an interesting angle. So think like community banks, mid-sized manufacturers, companies that could benefit enormously from AI, but definitely don't have the resources to build and run their own frontier deployments. Interesting argument. So like, if we start trying to unpack what this means, we can take an angle of one of the earliest to actually execute on this was Palantir. Was one of the most successful enterprise software companies of the last 2 decades, and its entire model was built on one idea. You can't just sell software to complex organizations and expect them to use it well. You have to embed engineers inside the organization, work through the mess of legacy systems and internal politics, and build something that actually functions in the real operating environment. That model made them extraordinarily sticky. Now, once you had a team of engineers inside a company for months and months and months, rebuilding core operational workflows around your platform, I mean, that's sticky. Good luck trying to rip that out. And that's the aspect of stickiness and getting those sort of tentacles in and attached to the workflows. So essentially what we're seeing here with these foundational models with OpenAI and Anthropic is essentially going after the same model applied to AI at scale, backed by several $billion. And the reason that they're doing this now, the reason they actually need to, is the deployment gap. I'm sure we've all seen stories around this, and enterprise AI has a problem. The models work, Claude works, OpenAI, GPT, whichever version they're on, whenever you're listening to this, it works. Those are impressive, but when companies try to actually deploy these systems inside their operations into legacy software, complicated permission structures, the compliance requirements, the internal workflows, the historic habits and ways that things have already been done, developed over decade, it starts to fall apart, or at least the complexity and the hurdles to adoption are real. And the gap between, this model is impressive versus this model is running reliably inside of our organization and measurably improving how we operate, that gap is enormous. If the models were easy to deploy, these services arms would not need to exist. Full stop. The fact that OpenAI and Anthropic are both building services companies at scale is admission the model quality is not the bottleneck anymore. Deployment is the bottleneck. So let's connect this to Southeast Asia specifically, because I think there's an opportunity here that not everyone is necessarily seeing clearly. OpenAI deployment company is primarily targeting U.S. enterprises. Anthropic also basically starting in that home market for them. Southeast Asia is not on the immediate roadmap, which means that the deployment gap in this region, which is real, and it's lasted since SaaS era as well. It's not going to be closed immediately by Silicon Valley. Someone local should and has to do it. The bank in KL running 50-year-old core banking system, the Indonesian manufacturer with warehouses full of paper records, the healthcare group across 5 countries with different languages, different regulatory frameworks in different markets. These are not problems that these firms are necessarily ready yet to parachute in and solve. They require some of the local knowledge, local language, local relationships, and the kind of long-term on-the-ground presence that a foreign firm cannot necessarily realistically provide as of yet. This is a business, a real one, and right now almost nobody is building it with the right combination of frontier AI capability and the deep local enterprise context. If you are building an AI services or an implementation company right now in Southeast Asia, this week's announcement should be considered a green light to pick up the pace and start going, and going fast and hard. The 2 most credible AI labs in the world just confirmed there is a structural multi-billion-dollar opportunity for the exact business to be building. Now, the caveat is, in my view, that this is not a go slow business. Now, your clients are inherently go slow, but the window it is to establish credibility in the relationships before these global players get here is not really unlimited. We need to move, and we need to move fast, and we need to take over this because, again, coming back to that, if you've built inside of there, you've developed it, it becomes very hard to rip and replace. I've talked a lot about the idea of the inversion of SaaS, where historically software as a service was very light on the surface and it was just an interface to do it yourself. Think about any of the software that you've used. It's an interface, but you still have to do it yourself. This idea is that you're building and deploying and understanding the specifics of the workflow. So essentially, you're creating agentic services. It becomes services as software. This is the time to build it. And I want to end this story with what I think is another major signal out of this. When AI labs start building services, it tells you something about the competitive dynamics in the model layer. If model quality was a durable, defensible, if being the best model was enough, you would not need a services company. I don't think they would be building these services companies if they could look at it and say, model alone is defensible moat, no one can touch us. And that just doesn't seem to be the case. You would just keep making the model better and let it sell itself. But that's not the case. The fact that both these companies are investing this heavily into deployment capability is a bet that the future isn't one at the model layer. That's the layer that I think is going to end up being commoditized over the longer term. It's one on the integration layer, the workflow layer, the trust layer. For founders that are building AI companies in Southeast Asia, that reframes the question completely. You are not competing with Anthropic or OpenAI on model quality. You can be a rapper. You never were competing necessarily on that. You were competing on your ability to take the best available models and actually make them work inside the complicated, messy human reality of organizations in this region. That is a winnable competition if you know what you're doing. Now, let's close this out. Let me bring these three stories together because I think they're telling one coherent story about where the ecosystem is presently. Funding market is leaner than the headlines suggest. Capital is concentrating. The number of companies stuck, not dead, not growing, is rising. Some silver linings around AI, some early starts, different markets are having different goes at it. I think we have tangible proof with IPOs like Skychip that are demonstrating that bigger ambitions can actually realize. Still a long road to go to validate that stays, sticks, and that the execution turning point of a moment of hype actually survives. And I think that the global AI labs just told you, with billions of committed capital, that the hard part of the AI opportunity isn't the model, and that Southeast Asia, if we put that in the context of Southeast Asia, the opportunity here is wide open. So founders who understand that and move on it in the next 12 to 18 months are the ones to be watching for. That's it for this week. If you found it useful, share it with one person who needs to hear that. That's all I ask. Give us a like, give us a comment, reach out. I'm Kevin. This is Sea of Startups, real, raw, relatable. See you next week. And that does it for this episode of Sea of Startups. If you've enjoyed what you've been listening to, please give it a like, give it a review, subscribe to our channel. A little bit of feedback goes a long way in allowing us to keep on putting out these kind of episodes.